Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, September 30th. The world over knows the House of Representatives failed to pass the Emergency Economic Stabilization Act of 2008. That no vote triggered a varied assortment of opinions on the matter, yet there was no mistaking the stock market's take on things. The failure to pass the plan unleashed a wave of uncertainty that drove the S&P 500 to its largest percent loss since the 20.5% decline on October 19, 1987, which left the S&P just above 224 that day. Yesterday, the S&P closed just above 1100, marking a return of nearly 400% excluding dividends in the interim. And that's after we navigated the S&L crisis, the Gulf War, the Asian currency crisis, Russia's debt default, the popping of the internet bubble, and the 9/11 attacks. Today, the futures market is pointing to a higher open for the major indices. In fact, if the current indication holds, the S&P 500 should begin the session nearly 3% higher. The positive disposition is rooted in the belief that yesterday's defeat notwithstanding, a relief plan will ultimately be agreed to in short order. Given what transpired yesterday, one can no longer be 100% certain of that outcome. However, it still seems to be the safer bet when taking into account the market's response yesterday, the spike in overnight lending rates for banks, and the multitude of warnings from key leaders of the dire consequences of not passing a relief plan. This is a highly uncertain period for the stock market, which means volatility is apt to remain high. Quarter-end activity by money managers, some strategic and some forced, is contributing to that expectation. To be sure, most 401k statements for the third quarter are not going to look pretty. The reduced wealth effect is undeniably taxing and will weigh on spending decisions. From an investor standpoint, though, one key point to remember in these tough times is that you don't truly lose money until you actually sell something at lower prices. Investors who held on in the wake of the 1987 crash certainly are richer for staying the course, both on paper and in actuality if they so choose today to sell at much higher prices. I'm Pat O'Hare for Briefing.com. Thanks for listening.